put stocks.tradingvolatility.net, but the amount of data that you get from this website for free is insane. This guy should easily be able to charge 100, 200 bucks a month just for this data. So the main thing that we're going to be focusing on with this website are the tools, the tab, more specifically the GEX dashboard and the dark pool dashboard and the max pain levels. So real quick, if we go over to the dark pool dashboard, this shows you current dark pool values. Um, and this website is always updated at the end of a market session, about like an hour and a half to 2 hours after the market closes, so it can gather the dark pool data. So DPI simply means dark pool index. Higher DPI values represent stronger dark pool buying. So what I like to do is I like to sort by DPI, and this kind of gives you a overview of which tickers um, institutions and big money might be accumulating. So if we click on Twitter, for example, it'll bring you to a visual chart on how you can see what the institutes are doing. It gives you its moving average. It gives you a 10 EMA for the dark pool, and you can just see even to like look at yesterday, crazy amounts of buying on Tuesday. So you get a visualization of the dark pool activity, and you also, if you scroll down, they have it linked with TradingView, so you get upcoming earnings, EPS, market cap, and you get an entire financials balance sheet. So the dark pool index is like a really insane way to get a watch list together and to kind of see what kind of stocks might be being accumulated by institutions. And so the next thing we're going to be going to is the GEX dashboard, which is really hard to explain if you're not familiar with the idea of gamma and gamma exposure. But the three values that we're going to focus on are SA GEX, call skew, and GEX dollar per 1% move. So think of GEX as market makers have to constantly balance their options books. Market makers make most of their money on the transaction fees, so they have to keep all of their books as neutral as possible, delta neutral, all that, um, for lack of a better, explanation. So gamma exposure is the dollar value of all the speculative calls that are currently open. When you have a high GEX value, this is implying that market makers are buying calls and selling puts. So that's like a borderline bullish scenario. So high GEX values is basically assuming that market makers are buying calls and selling puts. Skew adjusted GEX, they have a quick explanation on everything down here. Positive skew adjusted GEX, daily movement subdued as market makers rehedge by buying as stock falls and adding to shorts as stock price rises. So the moves are probably not going to be as volatile, whereas if you have a negative skew adjusted GEX, daily movement accentuated as market makers rehedge by buying as stock rises and adding to shorts as stock falls. So how do I use this data to find stocks to trade? So the first thing that I like to do is sort it by skew adjusted GEX. You want your highest negative values because this is implying that market makers are buying as the stock rises and selling short when the stock falls, so it can have that momentum behind it. Um, so what I like to do is sort that highest negative value, and then what we look for if you're looking for a long is you're looking for high negative skew adjusted GEX, and you're also looking for a positive high GEX value. So this is insinuating that market makers are buying calls, and then it insinuates that market makers are buying stock to to hedge the gamma exposure for those calls. And then the third piece of data that I like to use is the call skew. Obviously, if you have a positive call skew, that means the speculative call buying is higher and more so than the speculative put buying. So real quick, taking a look at the GEX. Basically, this is the dollars per 1% move that market makers must buy or sell to keep their books neutral. So it makes sense that if market makers have to buy a high GEX value with a positive call skew and a high negative skew adjusted GEX, that Amazon could be seeing a decent move higher. Whereas SPX, you can see we've got this huge negative GEX, which means that market makers have to sell this amount to keep their books neutral by this expiration. So this is today. So then it makes sense because you have the Fed meeting going on today. So you have a -8 call skew, a high negative GEX, and then a high negative skew adjusted GEX. So you put all that together and it tells you that market makers are selling or buying as the stock rises and falls, which means they're going with the trend. The GEX value tells you that they have to sell this amount to keep their books neutral by today, and there's a negative skew value. So this could be telling you that market makers might be shorting the SPX today in in advance of this Fed meeting, which makes sense because you've got this cascade down. All this stuff is kind of like Chinese, but if you like take the time to look at it and observe the market, then for the following day after the data has come out, it starts to make a lot more sense. Like I said, everything you need to know about is down here, all the notes, and after that, it just comes down to practice.